Good afternoon, everyone. Morning for some, evening for others all over the world. Welcome to today's live trade session. This picture was taken a few years back in my living room. It's back before I was really letting my beard grow longer back then. So, that's the difference. Why you probably don't recognize me in this photo. So anyway, welcome to today's call. We got a lot to go over. We're going to do a lot of comparisons as normal because that's the best way to understand what we're doing and the price changing of all of that. So we're going to get into all of that. We're going to be talking about risk-free calendars a little bit today towards the end of the session. So we'll cover that as well. Before we get started, I just want to update everybody on where we're at with regard to the offering of the trade partner stock to anybody. Anybody can buy any amount of trade partner stock, almost any amount. But literally, if you only want to buy $100 worth of trade partner stock, you can actually be an owner of the trading platform that you use. And it's a unique situation where the SEC allows small companies like myself to make a private offering of stock to anybody. You no longer have to be registered, or excuse me, you no longer have to be an accredited investor or sophisticated investor or pony up hundreds of thousands of dollars like the normal way to get into these kind of things has been over the years. We're almost done. We've got a couple of things that we will submit today. Then we'll wait for the SEC filing to get back to us, and I think that we'll be ready. So it is coming, and just want to let you give you an update on that. And again, I will be doing an extensive video for those who are interested again here in the near future. All right, for those that are new on the call, and if you don't know what Trade Partner is, you will see a little bit of Trade Partner today. But I do want to welcome you on the call. I also want to warn you that I do not explain everything about these trades on the call. It is impossible for me to do so. We cover a lot of ground in these calls, and these calls are not designed to meticulously explain the details of every single trade or strategy approach that we're doing. These calls are meant to be cumulative. You need to attend them for months. And believe me, you will get a really good idea of how these work. You'll watch them in action because I take the trades. Everything that you see here are actual fills, live trades. And so it's just something that you have to commit to over time. And it is well worth it, as you're going to see from these trades. However, these trades are fantastic, but you need to make sure that once you start taking them, you need to start small. You need to make sure that you are not being reckless in how you put the trades together. You need to make sure that you wipe the dollar signs from your eyes. You gotta baby step before you run. Baby steps first, right? So, and then make sure you follow the instructions, and that includes the instruction of starting small. Many traders come into this and they see the potential of these trades. They don't properly interpret something that I've said, or they missed it, or they put the trade wrong. They end up making a mistake, losing money, and they did it on a 10 lot, 15 lot, 20 lot, whatever the case is. And then ultimately, you know what they normally do? They normally start trading one at that point, and they say, okay, yeah, I guess I do need to learn a little bit more. And so that's the way it goes. And you don't need to start big because it's the compounding. I drive that home in every single course or every single session that we do. And I know some of you are getting tired of it, but if you've been doing this long enough and you're starting to see the fruits of your labor, so to speak, you understand how important this is. If you can average just $100 a week over the course of time, in this example here, this is about 6 months. If you can average about $100 a week for 6 months and apply my compounding, you're talking about growing your account by about $30,000 $30,000 after 6 months. If you can't average $100 a week, which most of you are not going to do at the beginning, you are still in a massive compounding scenario. Now, you're not going to grow at $30,000. If you average just $20 a week, you're not going to grow it by $30,000 in 6 months. It's going to be much slower growth at the beginning. But over time, 5 years at $20 a week, you're still going to beat the best performing stock over the last 7 years, which is no longer, by the way, GME, which I told you guys it wouldn't be. But nonetheless, all we're trying to do is average a little bit per week. And I give you many different approaches for how you can do that. And if you can get to the point where you're averaging, let's say you start with $20 a week, and then you do that successfully for 4 or 5 weeks, and so you begin to tweak what you're doing just a little bit to make a little bit more, and you go up to 40 and 50, maybe $60 a week on average over the course of 3 or 4 months. At that point, you're improving your weekly average. And if you can get it to $100 a week, you're talking about $3 million after 5 years, right? So your focus should not be on making it big right now or going bust. Your focus shouldn't be on, I either make money my first month doing this or I'm done. That's a trading 101 mistake. That is a beginner mistake, a newbie, amateur. You don't do that. So you need to take the time to learn it, and your focus should be on becoming profitable first, and then increasing that average overall net return. The payoff is that being your focus is going to be pay off far, far, far more than anything else that you are doing. Okay, now as we get going, I always start with option insanity first, or at least since the markets have been doing what they've been doing. And this is this is one where you cannot compound quite as much, quite as fast, or actually not nearly as fast in this particular example, but that's only because of the margin requirements that are required based on these. Once you get past a certain level, as far as your account size, you can compound normally. Plus, these can be used in cross compounding. Cross compounding is simply where you take the profits of one strategy that may compound slowly and apply them to the compounding profits of another strategy. So you actually increase the rate at which you compound another strategy. That's why I show these trades in this context. Because they are wonderful. With the crazy calendars, which we'll get to here in a minute, but with the crazy calendars, they don't take a lot of margin to put on crazy calendars, right? So we can compound those much more efficiently, and because of that, most of us are not using all of our account in crazy calendars, right? We've got money that's sitting there. This is for that. And you need to make sure you have enough to be able to do it. But here is the trade that I started with several weeks ago, and got into it at an entry of $2.85. And option insanity is any option spread where we're selling Monday and buying Friday. Selling Monday, buying Friday. So we're selling the further away option. We're playing the volatility drop is what we're doing. Been doing this for years, to some degree, based, back when they introduced Monday options. And so this is one of them that I play, and you can't play a lot of these, but the probabilities are just super fantastic, and you have pretty significant profits available. If you are to do nothing else other than some form of this option insanity trade, where you go far enough out of the money, make sure you have a high probability, you'll kill the overall S&P return over the next year. In fact, you can almost kill it in about 3 months the entire year return in about 3 months with this trade. So it's nothing to sneeze at, even though it requires a lot more margin. So this trade right here, at the time, actually required just a little over $10,000 in margin, about $12,000 in margin, and so I did it at a 285 credit. And the reason I did it at a 285 credit was, and you'll see here where the market was when I did it. I was trading at about 382-ish, and I did it at a 285 credit because the market had been moving up significantly. And so I did it a little bit closer to the money, and I was just going to use it based on time value. However, after I got in, the market tanked, right? So I have a 285 credit, market tanked, trading down at 370. There's no, and I had a $285 open position profit a couple of weeks ago, and no reason whatsoever um, why I couldn't take it, other than the fact that if the market moved back up, right? Because if the market continued tanking, I'm still going to make my $285 no matter what. Period. End of story. Everything expires worthless, and I make my $285. However, if the market began to move back up and then move into my profit zone, very high probability that I would be able to take a higher profit. So I held on, and the market not only just moved back up into my profit zone, it flew into my profit zone, like entirely too quick, and ended up now we're trading at we were trading at 390, so we're starting to get to the right side of the profit zone. And so we did it so fast that I went ahead and I did something that I normally don't do. I could have gotten out at about a $400 profit, and that would have been great, except for the fact that I was able to hedge it. And by hedging it, that allows me to hold on to it for a bigger profit, and it allows me to then profit stack, so I can actually put it on another trade by hedging this, because I know I don't have any risk here, right? Or I shouldn't say I don't have any risk. My risk is very, very small at this point, and very limited, right? It's not the bigger risk, which is normally associated with the five to one option sanity trade. And I also replaced my 282 call with a 385 call. And that's because we were trading at about 391 when I did it, and I was able to replace that 3-point strike difference for 292 credit. So it cost me about 8 cents. It cost me 8 cents to replace that long call. And what does replacing the long call do? It opened up my credit. And so the market, with the market coming back down, if the market came back down, I now have a minimum credit of about $510 on the trade. My risk to the upside is very small, and this is based on open position. And in fact, when we were trading, well, as of right now, we actually do have about a $485 open position profit on this trade. The only caveat here was that my replacement, my single long call, which was the 382, then was replaced with the 385. I actually replaced it with a February 10th 385, not a February 12th. And the reason I did that is to create this credit, and I felt if the market moved down, I would be able to replace it again, which I did, and I replaced the 385 call with a February 16th 390 call, and I did that for a pretty big credit. I don't have that graph on here, but basically what happened is that I opened up my credit even a little bit more to the downside by about $100 actually. And so now I have basically about a $615 credit on the trade. And right now, that trade is sitting at a $485 profit. Or actually, it was sitting at a $485 profit about an hour before the call. The market moved down a little bit. Let's see, where are we at right now? So this one is it's trading at 270, 200. It's trading at now almost a $600 profit. And we're trading at about 389. So I'll probably end this trade before the end of the day because I've already got like very close to the maximum profit. It's actually a little bit higher now because I did switch that long once again. But I actually have another 500 $500 in possible profit because these things are trading at about 108. My 392 calls. So let's see, do I have this here? All right, so my 392 calls that I'm short 5, these are actually trading at about 108. And I've made about $400 on my longs already. And so, or yeah, on my longs total. And so my shorts here, theoretically, they go to 0. They're not going to go to 0 tomorrow because there's still a day left on them. But they're trading at 108 right now. So I've probably got another, if the market stays about where it is right now, I've probably got another $200 that's available on this trade. I'll make a decision before the end of the day based on where we're trading at, because what I don't want to do is I don't want to see the market make a significant move up tomorrow and then just, and it's not like this, it's closer to like this. But I don't want to give back. I got about a $600 profit right now. I don't want to give back half of it on a move to the upside. So I'll probably go ahead and get out of that. And what I did was when I originally hedged it, which was early last week, this is the trade that I hedged it for. And again, I went for a bigger credit because the market was moving up. And right now, and I also changed it just slightly, and I made the strike difference 8 points instead of 10 points. So it's a 5-to-1 with an 8-point strike difference. Created a credit of 350. I wanted to create a bigger credit because the market had been moving up, and so this one, the break even is somewhere around 401, and this one has a couple of weeks left on it. And I'll look at it, whether there's any adjustment that can be made to lower the risk or, whatever, but we're not there yet. Right now it's sitting on about $150, about $147 loss, as you can see here. That's actually, let's see, where are we at right now? We are at 398 call. We are actually right now at a $80 loss. So we're actually a little bit better. $80 loss on this trade. And the market's trading below our long, right? So I'm not at all worried about this trade. Could it pop up and then put a little heat on me? Absolutely. But as far as this trade is concerned, there's no reason to do anything other than just let the time value drop on it. Because if we stay here for another week, I'm going to have a very significant profit, and I may go ahead and take the profit at that point, or I may, if I can, I may hedge it and profit stack it. So all sorts of things that I could do. Stay tuned to these calls. You'll know what I'm doing. So we'll take a look at some option insanity trades there right now because, or in a minute, I should say, because if I do end up exiting this trade today, I'm going to immediately replace it. And I'm going to replace it with a pretty significant credit on the thing. So, all right, let's move on to the next option, Sandy, that we were looking at. This one has very little risk. So it's very difficult for some people to put on this trade to begin with, right? Because you've got this area. If it goes past 395, you're talking about a pretty significant loss. Potentially, if it were to absolutely skyrocket, that's why we put them way out of the money. I've got one gentleman who puts on a trade that has about a 98% probability of success. If you're to hold on until expiration. He just automatically goes that far out of the money, doesn't pull in a big credit, but he does pull in a pretty a decent one, between $50 and $100 usually. Creates a 98% probability if you hold on until expiration, which we don't do, by the way, as a general rule. I held on to this one longer because I hedged it. That's why I held on to it longer. If I did not hedge it, I would have been out long ago at a $400 or $500 profit, as it was going through the profit zone. And I also want to back up for a second. I want to circle back. So, some of you will get it, some of you won't. I'm going to circle back for a second, because I do want to point out something. Somebody asked me a couple of weeks ago, why not just sell the options, and then do a margin hedge? And if you're not familiar with this, a margin hedge is simply where we buy a 216 expiration that's way out of the money, pay a couple of cents for it, and that just reduces the margin on the trade. That's all it does. That's the only reason that we're doing that. And somebody asked, why don't I just sell these? Why buy the one call? Well, about an hour ago, I should say an hour before the call. Yeah, about an hour ago, maybe a little more than an hour ago. This thing was barely break even. It was trading at about 145-ish. Okay, so I had about a $60, $75 profit if I were only short the 5 calls, as opposed to at that time sitting on a $460 gain, with my current trade. Now it's at it's about at about a $600 gain right now. So that is why this profit bubble here is really, really powerful. That's why we stick that long in there, and do that. So a $460 open gain versus a $75 open gain. That's the difference between adding this long in there as opposed to just having short 5. It's a huge difference. All right, so wanted to quickly touch on that. All right, so here is one that we started looking at a couple of weeks ago. Said if you can put this trade on at a 0 credit, you're going to have a really solid trade. There's still risk to this. I know this shows very, very little risk at these 2 points, and because it's on at a credit, there is no risk to the downside technically. If it crashes, the risk to the upside, it's there, but it has to happen. It has to happen fairly close to 390. So if it's in the money by any significant amount, you shouldn't be losing much. So long story short, the risk on this trade is really small. Like probably around, on average, worst case scenario, about $30 or $40. And in the meantime, you've got this big profit bubble that is available, right? So the pattern for this is 10-point strike difference between the longs and sell two shorts, Monday shorts that sandwich it. And that's what creates this symmetrical pattern, if you will. And again, this one, because it's option insanity, it's going to require a little bit in margin, but anyone can do it if you've got the margin, because the risk is so small on this thing. Anyone can put this trade on as long as you have the margin. You will have to do a margin hedge. So at 415, this would cost you about $6,000 in margin to put on. But that's not the risk. The risk is like $40 or $50 in most cases, and really, no, even in the absolute worst case possible scenario, you're still talking about just a ridiculously small loss. And what has to happen is that the long or the shorts have to maintain a lot of extrinsic value, even though it's either 5 points in the money or 5 points out of the money. At that point, right? So if the market's trading at 380, then the 385s are 5 points out of the money. How much extrinsic value is going to be retained at that point? If it's 20 cents, then your loss is going to be 40 cents total. If it's 20 cents a piece, your loss is going to be $40 total. That's it. If it's $1, which is not anywhere even close to what a 5-point out of the money option trades for on Monday, as long as there's not any bizarre situation going on, like you want to check the news and you want to make sure that the Fed isn't speaking or making a major announcement on Monday, because they will hold the value in for that. But if there's not something like that going on, you're talking about very little value for out of the money. It holds the value a little bit more for the in the money, and so that's why you have pretty much the same thing. So this one last week actually closed out at a pretty decent profit. I think $133 when we were trading at about 389. And so this one this week, right now, as you can see, is actually trading at a credit of 21 cents. And so if you get in at uh, zero debit, zero credit, and now it's trading at a 21-cent credit, and that's the mid price here. And then you're losing 21 cents. This was the quote at the time the market was trading right about 390. And so we're trading at 390. Worst case scenario, we are trading at the worst possible spot, and it's got a 21-cent loss. And it closes tomorrow, by the way. So if it moves back into the profit zone, you've got a pretty hefty, pretty significant gain. There's absolutely no reason why you would exit this trade right now at a 21-cent loss, when the probabilities are, if you were to place this trade on right now, at a 21-cent credit, you would have, over the long run, a pretty significant high probability of long-term success, because 50-50 shot that'll move up and you might still lose 21 cents. But if it moves down, your gain is going to be much, much, much bigger than what your average losses are going to be. So there's nothing wrong with putting this on the day before, and if the market moves down, great. Or you can do it to where if the market moves up, it moves up into the profit zone as well. But I don't think you can get that one at a credit. So we'll take a look at those here in a second. Then we went through a couple of ones that were a little bit different. They're offset, and it's just a way to manipulate the pattern to achieve either a more bearish scenario or more bullish scenario, etc. And this is one that we had on, and we actually lost a little bit of money. We lost 26. Actually, on this one, the worst price was 136. I think I only lost like 10 or 15 cents on this particular trade, and we were trading up here at around 389 at the time that this trade exited. We'll take a look at some of those, and then of course the W trade. Why am I showing you these? Because these are the ones that have lower risks associated with them, and can be put on like within a couple of days, even the day before expiration, and you can often get a pretty good trade on, as long as you have the margin. Okay, and then one slightly different, which is a 1-2-1-2. And I'm not going to go over any of these today, but you can see here how you can put these together. And if you know what you're doing, you can create a pattern that helps you make money in a scenario where maybe you don't have a solid trade on. Maybe you have a crazy calendars trade that is going to lose 50 bucks, 60 bucks, 100 bucks, whatever the case may be. And so you put on one of these, and you've got a scenario where if the market stays here and you lose $100 on the crazy calendars, then you might make $100 on the option Insanity, or something like that. So you can take this to a whole nother level. My strong caution to you is that you learn each one first before you start trying to synergistically trade them. Make sure you understand each one first. You've traded each one for a period of time. Yeah, you can trade them synergistically now, but don't be trying to do too many things. You'll screw it up. Trust me. Even if I'm trying to do too much, I screw it up. So keep it simple to begin with. You can always get more complex later, but keep it simple to begin with. All right, so let's kind of shift gears a little bit. We're going to start comparing all of these, but I want to go over the trades that we have so you can see how they work out. Here is a trade that was filled on January 25th that we've looked at over the last couple of weeks, and we've been patiently waiting for this one to come to a completion. And this one was placed on at a credit of 84 cents. And if you recall, I placed this on at a credit of 84 cents because I wanted more profit if the market stayed the same or moved down. So the bigger the credit, which is right here filled at 84 cents, the bigger the credit, the more profit that is available to the downside, or if the market stays the same. And so you can go and see this was filled at 3:56 p.m. on 125. You can go see where the market was trading and see how that works out. Well, of course, the market moved down and then it moved back up, and now we're actually trading really close to the 390s, which is crazy for what happened. So the crazy calendar had some crazy action going on, but I was only in 3 calendars, and I only did 3 calendars because of the lower probability of the market moving into the 390 area. And of course, we did that. So, probabilities are not certainties. I've said that many, many, many times. However, because we were at this trade at a credit of 84, this was trading about an hour before at a debit of 26 cents, giving about $115 profit on the trade. And of course, most of you are will have taken this before $115, because at 390, that's your calendar, that's your profit peak. After 390, that profit starts to go away. You don't want to hold on to this until tomorrow under any circumstance, period, end of story. Yes, we could go to 390, and yes, you could see you could see a profit of maybe $250 on this trade. Maybe not quite that, because you have an 84-cent credit, right? But you could also go to 392 and 393 and 394, and at that point, you've just given back this whole entire thing, and possibly will be sitting on a loss. You don't want to do that. So under no circumstance, if you find yourself in this situation where you're trading around the calendar spread, a day before expiration, you're sitting on $100 profit, under no circumstance should you hold on to that. The whole purpose for us getting into this is not to take advantage of these bigger profits, but to make sure that we put ourselves in a high probability of realizing the gain, right? So rarely do I hold on to these until expiration. Rarely. So on this, if you're in this one, if you got, and this was an official trade that we took, that we were looking at during the class, and if you took this, you should be out now. And I think I don't know where it's at right now, but you absolutely should be out. And I'm stressing this because some people don't do that. And again, there's a reason that these option insanity trades work in the current market conditions. And it's because you see the value of those Monday longs drop significantly on Friday. And so any move up, and you're going to be putting yourself in a pickle. All right, now, this is not an official trade. This is not a trade that I took during this class or even presented during this class. I took it in another account because I was repositioning, and I was being fairly aggressive with it. And so what happened with this particular trade, which I'm about to show you, is that the market, I placed it on when the market was trading in the early lower 370s. Okay. Again, repositioning. So I put it way out of the money. And this is where it's at. Of course, the market shot to the upside, went completely past my profit zone, and has been trading past my profit zone for well over a week now, and I've never had an opportunity to exit this thing at a profit. And right now it is trading at about $147 loss. So this does happen, especially if you're aggressive with putting these on. So you'll see this was filled on 129, and it was filled on 129. Again, this was after the market had moved back down into the mid to lower 370s, and so at the time this was still about 10 to 11 points out of the money before you even reached the second the short strike. And it was about 13 to 14 points out of the money for the calendars. So nothing wrong with this trade, but as I've said many times before, when the market moves down, that's when it's susceptible for a bounce. So you got to be extra careful when you get into those like that. Now, with this, I also did placed on. Oh, and by the way, these are 219, 222s, 219. So I went pretty far out. But when you do place these on and the market moves past your profit zone, you can add to them, but you are also adding to your risk. You got to be careful of that. One benefit that you can do is when you're in these, if you have a little bit of capital, if you have the capital and you're able to do it, you can put on like a 387, 397 option insanity trade for a credit and offset that. That's how synergistically you can plan those trades out if you're taking both of them. All right. So we'll watch this one. I'm still in it, not going to get out. Like I said, with all of these, you have to accept the risk of the trade. Period. End of story. If you don't accept the risk of the trade, then don't get in. And the risk on this trade was about it's about $370 total, because it's a 4-point strike difference with the diagonal spread. So it's 4-point strike difference minus the credit. That's 3. So you got $300 risk there, and then you add the 3 calendars at 27 cents a piece. So you got about $380 max risk on this trade. And if that happens, it happens. I've got other trades, including option insanity trades, that will make money up here if the market stays up there. Okay. And then we talked about this trade, and I believe this trade was placed on last week. I want to say it was placed on Thursday's trade, on Thursday's session. And this was similar in that we have a 390, 395 credit, right? 390, 395 credit. And then the calendars are at 393. And again, I'm only doing 3 calendars here because the market is so high up that I'm not, I'm kind of muting my profit bubble, if you will, a little bit. And so I'm focusing on the credit. So this is a 50-cent credit, and muting that profit zone because of the lower probability that the market was going to continue moving up at the same pace that it has been. Of course, it did and has, but it also has, at least for now, it's given a short bit of a pause. Whether that continues or not, I don't know. We'll see. But this is another trade where it is possible, if we resume our move to the upside early next week, that we may not have an opportunity to get out of this at a profit. Right now, I shouldn't say right now, about an hour before the market, or before this call, it was trading at a 101 credit, which means I'm losing $50 on this trade. But I'm not worried about it. We're still at 390. or the first short strike is still 390. That's where this was at the time. We're now trading below 390. We're trading at 389. It looks like 40-ish. And so there's no reason for me to panic on this trade. If it starts to move up, it'll start to move up towards my calendar spreads. Where Thursday, tomorrow should be fairly quiet unless there's some weird announcement on the. We're trading at 389 now, so unless there's some weird announcement on the unemployment, I think that's the one that's coming out tomorrow. Markets should be fairly quiet here over the next couple of days, and time is what we need because this will show a net profit over the next couple of days if we stay down here at around 389. All right. So that's one. And then there's one that we placed on Monday's trade. So this was filled from Monday's trade. So 2.5, as you can see here, 2.5. So this was filled at 12. This was actually filled before. So I think this is one I showed you guys, right? So we talked about it. And again, this is one where I basically added on. This is a 393, 398. So same thing, 5-point difference. 5-point difference with the calendars in the middle. Only 3 of them. Total credit of 26 cents. That's pretty standard with what I've been able to do. But I've got calendars now at I've got calendars at 393, and I've got calendars at 395. And so between 393 and 395, I should be looking pretty good at, as far as next week is concerned. Beyond 395, then I'm going to be losing on this trade, right? At 395, I'm going to be losing on this trade, and I will be losing on this trade as well. So you do have to be careful if you put these on too close, and you can't afford to add on to the trade, then you need to go further out of the money to begin with. And that's just the rule, right? If you can only put on one trade at a time and you can't add to it, you need to go further out of the money and create a higher probability of success. All right. All right. So let's take a look. Let's start doing some price comparisons. And I'm going to start with Option Insanity price comparisons. That both for right now and, oh, don't tell me that, do not tell me that they all disappeared. All right, well, I'm going to show you, here's what I'm getting. So it's blank. Let me see if this will come back up here. And if it doesn't, I'm gonna be ticked. Because I prepare these things beforehand. And part of the reason is because we're in a deep freeze and my internet is actually satellite and I've got ice on my internet. And so hopefully y'all haven't heard this thing crackling, the sound at all. Let's see. Yeah, I don't know if that's my internet. So in the time being, let me pull up a different one, and we will get the same thing, of course. All right, so 1 second here. Spread patterns, and they're all saved. So I'm going to start with the 111. No, I'm going to start with the 121. That's what I'm going to start with. All right, perfect. So fortunately, they did save. And here they are. All right, so here's the 121. First of all, let me give you a picture to look at. Here's the 121. Okay, That's the 121, or the 211, or the 112, however you want to call it, but that's it. And so this is where the current prices are for this, right? So 121 is the 380, 390, 385. And this is one where, we're basically trading at 390. And I'm going to go ahead and we're going to take a look at all of them to get a wide scope. So you get a picture, and then we'll look at what's available. 395, I'm going to say 400. And of course, this is trade partner. Whoops. What did I do? Oh, yep, I got to do 395. All right. So of course, this is trade partner. This is my pattern spread generator, where we plug in one pattern, and then we tell it to look for the range, and then we can just look at the different patterns. So 375, 385, and the 380s. Right, that's where that's the profit peak, and it's trading at about a 41-cent credit right now with the day to go. And all of these are trading at about that until you start to get to the point where we're actually below the second long. So here's one where we're below the second long, and we're kind of trading kind of in between the two longs here, not quite at 386, but we are in between them. You can see here that credit right now is at 3 cents, and then it's going to go into debits, and that's the open position profit that would be in place if you were to get into this at a credit of 0. And so you can see here, even with a day left, the 385, 395, 390s trading at a 98-cent debit. So we're actually trading a little bit below the short. Go a little bit higher, and you're looking at about $1.10. And here's $1.10. Here's $1. And so you can see that we are in a wide range where you have open position profits early. Okay, so $1.10 is nothing to sneeze at if you're in this. Let's say you're in this one, and you have $1.10, and there's a day left to go. We're trading kind of like right in between the profit zone. You don't want to see the market tank and give that back, and you don't want to see the market necessarily. The market has some room to go up, and you're still going to see a pretty significant profit. But if the market drops down, then that's where you might see your profit go bye-bye. All right, so let's take a look and see if there's anything available in the next couple of weeks. So we're going to change the dates here. We'll reset the spreads, and we'll go 3. Let's go 326. Whoops, 326, 326, and 226 and 31. All righty. So let's go ahead and generate and wait for these to come up. And I'm going to get to the risk-free calendar here in 1 second. Okay. All right. So here we're trading still credits. So, you already know, if you get into this, your sell is at 381. That's going to be your profit peak, right? And if you get in at a credit of 34 cents, you already know that you're probably not going to be losing money if we stay here. And so, this would be a bearish type trade where you're not going to make anything until the market gets to about 386-ish, 385, somewhere around there. Okay. But let's see how far we can go before we can't get a credit. So that would be about 383, 393, 388. So this one's not bad at all. If you can get a 384, 394, 389, that's exactly where we're trading. Right? We're in the profit peak, but unfortunately, that's 2 weeks away, right? So if the market tanks, you might lose $30 or $40. If the market moves up, you might lose $30 or $40, depending on how far it moves up or moves down with either of these. But you have a wide range where you can make money. So I don't normally trade these alone. I'm usually putting these in an area where the profit peak is where I might lose a little bit of money if I can get them, if I can put them on, right? So if you go too far out of the money, you'll notice that these are all debits, right? So you go 391, 401, 396, those are debits. You don't want to put on a debit on that trade, okay? Let's just go ahead and skip to, actually, let's do this. Since, let's take a look at the 5-1 option insanity. And again, this is based on where they are right now. So I want you to see the different prices of where it's at. Okay, so we're going to start with 375 and 395. And 1, generate the spreads. All right. And let's see here. So here is one where we are just past the shorts. Now I got into one that was at a 350 credit. And so if I'm in at a 350 credit and we were just past, the shorts, then I've got a $100 loss on the trade. Obviously, these are being put on when the market is way below the long, or at least below the long for the most part, right? So, so the market has to move up, and if it does that, you can see that that's a loss if you were to get in at a 350 credit. Go 1 point further, and you've got over $100 gain, and that gain begins to really pick up as you go into the middle of the profit zone. So right now it looks like about 330 is where the profit peak is at, and that is right in between, right in between the long and the short. If you get in at a 350 credit, and this is where it's at the day before, you're looking at about a $700 profit on the trade, right? So it is significant, and you'll see that it is significant all the way at that point, because everything at that point is going to be at a debit, a small debit. So if it moves down, obviously, that's where you've got your $350 gain if you get in a 350 credit. Okay, so let's take a look at any that might be available for the next couple of weeks. So we'll go 226 and 3-1. And let's see here. So some nice big credits. And here we are at basically right where the market is, credit of 176. That's actually not a bad scenario. The shorts are at 399, and that puts the break even at approximately 401-ish, based on this pattern, maybe a little bit better. So that's a long way away, and a couple of weeks to go on this trade. Not a bad scenario. How far away can you get and still get a credit? You can go all the way to 393.403. Puts the break-even level at about 404 because you don't have as big of a credit. But at 404, that's the break even, and those things are only trading at like 68 cents a piece. And you can actually put together a little bit better spread than that. But that just shows you how far away you can go and place these on. So if the market does anything other than close at 404-ish or above in 2 weeks, you're going to have a profit on this trade. And it could be significant if it's in the middle here, like at around 399, 400, somewhere around there. Okay. So that's available. That's what's available right now. All right. So now let's take a look at risk-free calendars. The core trade. Somebody had requested, let's take a look at the core trade for the risk-free calendars. And the core trade is where we go it's sell 1, sell 2, and then buy 3. And I'm not going to show you a graph on this today. I just want to show you what's available. The purpose of this is once this is placed on, we then look to buy another 386, 216 expiration, 386, creating a calendar spread. And we look to buy it at basically what we sold the 386 for. That creates a risk-free calendar at that point. And at that point, you can either leave it, or you could get rid of the underlying spread, and you only have the risk-free calendar. Obviously, you want to make sure you have a profit if you do that, but that's the purpose. So we're going to take a look at these three. We'll go 383 and 402 and 1. All right, so we would put this on first, right? We'd put this on first. This is the core trade. Obviously, you would need to put it on at a credit, and you want to go out of the money. You don't want to do this one. I only use this one as an example so that we can see the price differences. But here's a 357, 358 credit, right? If you can get this for 358 credit, you have to buy the extra 387 for something less than 358 or 360, right? And in this case, it would be 330. So you would still have a 30-cent credit after you buy the extra 387, but we're in the money on this one, and we don't want to do that, right? We want to start with going out of the money. So we'll take a look. If you were in a 388, 392, 393s from, let's say, $1 credit. Right now we're trading at about what, 389-ish. I don't know where exactly the market is right now, but 389-ish. And you can see here that would just barely be breaking even if this is the one that you're in and it expires tomorrow. So if you weren't able to get another calendar, which you would have been because of time, but if you weren't able to get another calendar at extra long or whatever the case is, then you've got a situation there where you're just stuck with the spread, and it is what it is, right? And so if you get in at a spread of 1, and then it goes way in the money, and let's say it goes to a credit of 405, you're sitting on a $300 loss there, right? And this one's pretty far into the money at this point, 2 points past the long strike. And that's with only, again, that's without the extra long in place. Okay. All right. So want to look at that, but let's take a look at these a couple of weeks away again. So it's 226, 220, whoops, that's 222, 226, and 31. And we'll reset and generate. All right, so this is, let's see how far we can go and create about a $1 credit. Look at this. You can go all the way out to 396, 400, 401s. That's tremendous. So break-even level on that a day before is going to be around 397, right? So we're it's on up there a little bit, and the long right here, you can see here the shorts, which are 400. That's the calendars that I would be creating, and I would put it as soon as this is filled. I would put in a order to sell, to buy a 3-1-400 call at 98 cents, and then that gives me a zero entry, with the purpose of then selling another 400, and then buying another 400, and then selling another 400, and then buying another 400, as many times as the market will give. And it's all done within the confines of this core trade. And you can actually exit the core trade at any time you have a profit, and just hold on to whatever risk-free calendars that you've got. And that's a great way to trade this. You're not going to make a ton of money most of the time by doing it, but you're only looking to average a little bit of money every week, right? And you can compound these pretty much according to the same compounding plan. Okay, I will spend more time on this one on Monday. We'll start looking at some graphs. I'll throw up a trade partner smart order file and send a template to everybody during the call, and you can kind of see how it works, and we'll just go through the process nice and slow. In the meantime, I'm actually going to put this trade on. I want to put this trade on, and I'm not going to do it through a smart order, so I can go ahead and get it filled. So I want to go at $1 credit. All right, everybody see that? $1 credit, and I'll put it back up here in a second. All right, so whoops. So let me see here. Overview. I really need to have it where they open those in a different window. So let's see, SPY 1, 2, 3. So I will let you know if we're filled on that one here in a second. 1 second here. All right. What was the trade? Let me show you what the trade was. Maybe. There we go. All right, I'm going to pull this over 1 second. Actually, what I'm going to do, this is what I'm going to do. I'm going to post this on here. So this is the trade I've got working. All right, so if you want to put it on, you can put it on. What I will do when this is filled, and I will go ahead and do a smart order for it, not on the call, but to have it working, because I'm not going to sit here and watch it, is as soon as I am filled on one of these calls, or excuse me, on this, I will go ahead and buy a, did that do February 25th? Okay, well, I will go ahead and buy one of these 400 calls that are February 28th, which is actually March 1st. Why does that say 28th? I don't know why that says 28th. So it's actually 26th versus March 1st. So I will immediately buy a March 1st 400 call for $1, and then repeat that process. All right. All right, let's see here. You're getting uglier by the day. Yes, thank you. Appreciate it. You had created a webinar appointment for Crazy Calendars, but it was crazy. Yep. Yeah, I'm going to do a specific call for Crazy Calendars. I just have to try and figure out when in my schedule I can fit it in. Edwin, when I analyzed the 1-2-1 trade, the risk was much lower. Much lower than what? Much lower than my exact trade. So are you talking about risk being lower than this? Peggy, what if volatility changes a lot? So here's how this works. And if you're new on the call, I've explained this. I try to explain this like maybe once every couple of months. But in SPY, unless there's a reason for volatility to increase, it's not going to increase. It's going to decrease. So as the market is moving or within a small range of all-time highs, it is not going to increase unless you see a significant price move to the downside, or unless some sort of announcement is made for Monday that will hold the value of that option higher on Monday. Other than that, you're not going to see it happen. These aren't just random scenarios. You have to either have something come into the situation to not create this type of trade. So one thing that I do is I do look at a market calendar. So let me find it here. I'll just show you real quick. Okay, so of course markets are closed Monday, and so the options actually expire on Tuesday, right? So that does make a little bit of a difference. But here's the economic calendar, and you can see here there's really nothing going on Tuesday. Nothing going on Monday. Nothing that's going to move that's going to hold the value of these options, to extremely high prices. When see on Wednesday, these things don't affect Tuesday's options, right? So you don't have to worry about anything on Wednesday. So as long as this stakes pretty much stays the same, where there's really not a lot that's going to hold. The one slight difference in this week is the fact that there's an extra day, even though the markets aren't closed, and there are some things going on, but they're not major market moving issues as a general rule. So volatility takes that into account. All right, let's see. The last 1-2-1 option insanity trade that expired on 12/16/2/16. Yeah, there's nothing wrong with entering this trade right now at a 21-cent credit. Because you might lose a little bit of money, but if the market moves down into the profit zone, you might make $100, might make $150, and it's a 50-50 shot, right? So you've got an average win-loss ratio that's 5 or 6 to 1 potential in there. What credit do you look for when entering a W trade? Generally, in current market conditions, I look for about a 75-cent credit or better. If I can't get a 75-cent credit, then I don't get in as a general rule. But this is a 78-cent credit, and this was really close to where it was last week, based on the longs. Okay. Again, volatility could increase, but how much can it increase to pull this whole thing down by any significant amount at all, right? So your loss is always going to be small on these. As long as you don't put them way out of the money and then the market moves down, at which point the volatility will increase. If the market moves down, the volatility increases. That's just standard. And so you don't put these way out of the money, or in the money, I should say. Let's see here. In crazy calendars, when you get past the profit zone, if market comes back to the profit zone in the last day, profits can be amazing. Yes, Juan, profits can be amazing. It's happened twice on these live calls where we went past the profit zone in the crazy calendars, and the next day on Friday, the market moved into the profit zone. However, I'm very aggressive. If I'm on the last day, because I haven't had a chance to take a profit, I'm going to be very aggressive at taking the profit. I'm not going to get greedy because the market can move into the profit zone, give me a profit, and then by the end of the day, move right back out of it. And I would just rather take my profit and put on another trade that's out of the money, emphasize a little bit bigger credit, and go on my merry way. That's how I do it. All right. Hi, Ryan. I have upside risk from 389 for tomorrow. Can you please show what option any trade can be done to offset that? Let's see here. So you can put on something like this. You would still have upside risk, but you could put on something like this. There's a trade that I've got on. Let me see if I can't find a particular trade that I have on where the profit bubble. Let's see here. Oh, I was filled at $1 on the core trade, so I now will put a I'll now put an order. Let's see. So we'll just put this over here. Whoops. All right. So you can see I was filled on the core trade here. Right here. Here is a trade that I placed on. The profit peak is basically under 392 and over 386. So who asked that question? KS. So if I and I got filled on this, when was it? Monday. So if I got filled on this at a higher strike, so I push this whole thing up. So I take a screenshot of this real quick. Push this whole thing up and get in at where the profit peak is, let's say 392 to 393. That means your shorts are going to be 392 to 393. That should be really nice if there's a decent move up tomorrow. And you can see here I'm losing about $30 on this. The mid is at 142, and I was filled at 108. So I'm losing a little more than $40 on this one. But tomorrow, if the market moves down a little bit, and we're above 390 again. So if the market moves down into 389, 388, 389, I'm going to have about $100 profit on this thing tomorrow. I have a crazy calendar position expiring tomorrow with open position loss calendars at 387. Should I close now and accept the loss or wait until tomorrow? Mike, what's your maximum risk on that? And where are your calendars? Oh, you have calendars at 387. I see. Okay. 387. If you have an open position loss, if it were me and I am in some with 387s where I'm losing just a little bit, and you saw I was in some where I had 386s and I was losing like $150, I hold on. And if I can get it to break even, then I'll get that at break even, then I'll replace the trade. So I spend the time on Option Sanity at the beginning because they are the best trades right now. Okay, Option Sanity are the best trades right now. If you can at all put one on with low risk, I would absolutely do it. Yeah, and again, just watch them and whatnot. But I will flip the. I will reverse it. So on Monday, I will actually start with the. I'm going to start with the risk-free calendar core trades. Then I'll go into the crazy calendars, and then I'll do Option Sanity at the end. Yes, Gene. Spread generator is available now. You can log into Trade Partner and use the spread generator. Absolutely. The RFC isn't the pattern 213 instead of a 123. Risk-free calendar isn't the pattern. Stefan, it can be, but you're looking at a lot more risk if you do a 213 as opposed to a 123. Okay, you have a bigger credit, but you have more risk as well. So I'll go over that one on Monday as well, and we'll go through the differences again on those. Why add March 1st 400 call and not the 228 400 call? It actually is 228 is a Sunday. I don't know why the return path is listed as 228. It's actually a March 1st. Okay, great. Just wasn't sure if it was separate. Okay, you bet. Sorry, Mark, yeah, correct. So I was looking at what's available, what's going on Tuesday for this week's Option Insanity, right? If you want to look at next week's Option Insanity, whoops, you can see, whoops. Oh, I see what you're saying. So sorry. It's even better. Thank you for that catch. Time is flying way faster than than it should be. Sorry, guys. This is Monday, President's Day. Markets are closed Tuesday. The only thing going on is Empire State Manufacturing Index. Absolutely zero going on Tuesday. They will not hold the value in these longs tomorrow unless the market makes a big move. Okay, so is there a crazy calendar for today? So we've got a couple that we're in for next week, and so I didn't want to add another crazy calendar. So we'll do another crazy calendar on Monday and take a look at those. You're welcome, Mike. How do I expect the 3-1 and 5-1 trades to change if the market sees higher volatility? So it really depends, and we don't have to worry about that because if the market changes while we're in, that usually means the market moved down and we have credit, right? So it won't affect an open position trade, but we'll, if that happens, we'll obviously take a look at how it affected. Honestly, it most likely will allow you to just go even further out of the money. So if the market drops, you can still go way out of the money, even further than you can now. Is most likely what will happen in that scenario. Dano, if you're logged into Trade Partner and you don't see an option to use the pattern spread generator, then what I want you to do is I want you to go to, let's see here. Let me see if I can find it. In the upper right-hand corner of the screen, where it has your username, I want you to click on your username and it'll say broker authorization settings, smart share logs, settings, reset local storage, log out, etc. Go ahead and reset your local storage, log out, and then log back in. It should appear. It's most likely because it's cached in your browser. Is it worth to spread a risk by selling different strikes and 5-1 options in any trade? Derek, great question. And the answer to that is you need to make darn sure you can handle the risk of multiple 5-1 option insanity trades. I realize the probability is just ridiculously small that you'll ever, if you put them on right, that you'll ever suffer the maximum loss, but you can't ever say never, right? So you just want to make sure that that is the case. All right. Unless something has changed, the spread generator is not available on the free trade partner site. Yes, they have not stuck that on the free site yet. It is being stuck on the free version of Trade Partner, but it is not available for the free version yet. Sorry, that may be what the question was with regard to the spread generator. All right. All right, guys. Appreciate the feedback. I'll make sure that we pay a little bit more attention to the crazy calendars on Monday, as well as the risk-free project or the risk-free calendar core trade, and then go from there. Was I filled on? Well, I didn't place it yet. This is why I put it. This is why you really should use smart orders. But let's see here. I just want to take a look real quick on the March 1st 400 and see kind of where we're at. The 400 is trading right now at so we're about 18 cents away from getting filled on the actually 30 cents away from getting filled, but we've got a lot of time. That's a 400. We're trading at 390. We got a long weekend. I'd be shocked if it wasn't filled tomorrow or on Tuesday, as long as we don't make a pretty significant move up, and that'll be the first risk-free calendar. And we'll go over this on Monday. Actually, man, markets are closed Monday. We will have a call on Tuesday. I will make sure that we have a call on Tuesday and go from there. All right. Looks like I got all the questions. I will do the call on Tuesday, not Monday. If we do it Monday, it's not a live trade call. All right. Do you have a special link to TradeREC to sign up? Do they get paid for order flow, which usually results in bad fills? So, you know, most of our stuff is limits. We're not putting in trades. I don't know of a broker that doesn't get paid for order flow on some level, but you know, it does diminish it when you're in limit orders. We don't have a special link to sign up at TradeREC. Just mention my name and they'll be happy that you got involved. They'll get you the same deal. All righty. Looks like I got everything. Everyone have a wonderful weekend. And for those of you who are in the same boat I'm in right now, stay warm because this is ridiculous. All right, everyone. Talk to you next week.